Hello everyone, today's video is all about restricted stock units, RSU. What are they? Well, they're quite a common way for big companies, particularly tech companies, a lot of the American tech companies employing thousands of people in the UK now. And what they do, they grant them these basically options over shares in their company to say, right, you're going to get some shares in the likes of Facebook, Amazon, Google, but you don't get them all on day one. You essentially will be granted these, possibly on the first day that you are employed by them, and they are given to you over time based on performance criteria, hence the term restricted when we talk about RSUs. So let's dive in and look at an example. So let's assume you started work with Amazon on the 1st of January 2021, and they said to you, right, we're going to give you an award of 200 RSUs. So this stock, the shares in Amazon that you will get your hands on, but over a period of time. And let's say it vests over 4 years. So in this instance, 25% of the stock units would vest after year 1, 25% year 2, year 3, year 4, and so on. So in year 2, vesting 50. And then 50 and 50 and 50 in the subsequent years. And then assume also that how it works on this employee share arrangement is that for every year that you are with the company, you then get granted another tranche of these RSUs. So in 2022, you've stuck around for a year to say, right, thank you very much. We're going to give you another 200. And again, they will vest over 4 years. So 50 the next year, 50 the next year, and so on. And this is how it typically works. So restricted in the sense that you can't get your hands on them straight away. But what happens when you do get your hands on them, specifically from a tax point of view? How are these things taxed? So let's take a look. So in this example, let's just look at this one event here. The vesting of the first tranche of RSUs, 50 of them in 2022. Now, how are they going to be taxed? Well, let's have a look. So RSU vesting. Now it's all about the value of the shares at the point that they are vesting, not at the point that they are granted. So they're granted to you here, 2021. There's no tax implications at that date. It's all about what happens when they vest. So they vest 2022, 50 of the first 200. And let's just say it's £1,000 per share for the ease of the maths. So that's a £50,000 vesting value. Now, unfortunately, you have to pay tax on this. Which tax? Well, it's income tax and national insurance. But here's the rub. You have to pay employers' national insurance. Now, that never happens normally on things like bonuses, salaries. You pay tax, withheld under pay as you earn, income tax and national insurance, employees' national insurance, and your employer will pay employers' NI separately. You don't suffer that employer's NI. It's a burden that your employer has as a cost for having you as an employee, but it doesn't come off your tax. It's extra tax, but it's paid by someone else, your boss. With this, you suffer the employer's NI. So 13.8%. So in this example, 50 grand, 6,900 comes off that. That's employer's NI. So the value of the stock goes down to 43,000. This is before your personal taxes are applied. So income tax. Now let's say this person is a 45% taxpayer. So they're on a decent whack and it's 45%. That's £19,000 of tax right there. Employees' national insurance, well, we've got this 2% increase. Of course, as we know in my recent video, going up to 3.25% from next year for the social care levy. Anyway, but for now, 2%, the extra increment on national insurance for employees. Once you've hit a ceiling, you pay 2% on everything else. So that's that figure there. That gives you an RSU value after all taxes, 22,843. So just shy of 23 grand is what you end up with value-wise from 50,000. 54% effective tax rate. So that's high. Principally, oh yes, we've got a higher rate taxpayer in this example paying 45%, But it's this employer's NI, which the employee has the burden of. Yes, they're getting tax relief on it because their tax kicks in after you deduct employer's NI, but they've still got to foot the bill. So overall then, 50 grand RSUs in the first tranche, first time it's vested, you end up with a value of 23,000. Now, what tends to happen? Rather than on your pay slip where it says PAYE and everything else, and they withhold 20 something grand, whatever the difference there is, 27 grand in tax from your pay slip. What happens is that the company, the Amazons in this case, they will sell enough shares to cover your tax bill. So instead of you getting your hands on 50 grand's worth of shares, you'll get your hands on 23,000 pounds worth of shares, because the company has sold shares on your behalf of these units when they vested to pay your tax bill. That's what happens 99 out of 100 times, so that you haven't got what we call a dry tax charge. So that's great, that's fine, because you just end up with something after tax valued at 23 grand. Remember, it's something that was being given to you. Yes, there's tax on it when it vests, but you still end up with shares worth 23,000. Now at that point, you might say, well, what's the options? Well, the options are you could hang on to them or sell them. Now, if you sell them, from the point that they vest onwards, after we're done with national insurance and income tax, it's all about capital gains tax. And any future uplift on this value here is subject to capital gains tax, not income tax. So you might say, actually, we think this tech company that we're working for is going to go places. Amazon in this case. So the stock will continue to rise, we hope. So let's hang on to these shares. That's their base cost. That's what they are worth at this date. And assume you hang on to them. Now also assume that the shares approximately double in price after 3 years. So 3 years down the line, these awards that you've got valued at just shy of 23 are now worth £45,000. And then you decide to sell them. Capital gains tax, proceeds, 45,000, less the cost. Now the cost is this amount after you've suffered income tax on the vesting date. So that goes into your capital gains tax calculation. That's the cost to you. Comes off your 45 grand. You've got a gain. You knock off the annual exemption. Remember, everyone gets an annual exemption for capital gains tax purposes, which is just under the personal allowance threshold. It's 12,300, and that comes off capital gain. So you're left with a capital gain just shy of 10 grand, taxed at 20%. That's the rate of capital gains tax. So you've got a tax bill 1,971. Should you sell these shares that vested? So when they vest, you hang on to them. They're yours now. Value of 22 grand after all the taxes, and then they've doubled after 3 years. You sell them, you got a capital gain. So, but could you have got a better tax result? Well, yes, you could have done, because at this point here, at the point they vest, when they are yours and you pay the income tax and you've got this amount here, this is yours, you could sell them immediately, because remember, no capital gain, because you're buying it, you've acquired them and you sell them at the same time. There's no capital gain, and then you buy them straight back. However, you buy them back in an ISA or a SIP. So of course, if you buy them back in an ISA or a SIP, there is no capital gains tax should you sell them within those wrappers down the line in the future. Unlike the scenario we've just gone through, where the guy's paying 2 grand capital gains tax when the share price doubled after 3 years. But had he, at this point, immediately sold as well when they vested, no further tax on this, because there is no gain, sold them and then bought them back in a tax-efficient wrapper, an ISA or a SIP, and of course at that point there is no tax on any future uplift. So that's just an overview there on RSUs, restricted stock units, which are becoming more and more popular in the UK as the tech giants from the States grow and are awarding their thousands of employees these RSUs. And it's also prevalent now in many UK companies who are adopting this US model of these RSUs and offering them as incentives to their staff. So we're coming across a whole load of these, but this is basically how they are taxed. So just an overview there on RSUs, and if you like this video, please do subscribe right about there, and as always, I'll see you soon.